Good morning, ladies and gentlemen. Well, it's pretty tough finding a new theme each and every week, but my theme this week actually is that I'm turning slightly more cautious on the equity outlook and slightly more bullish for the next couple of weeks on bonds. Just a little counter trend phase, I guess. But this is what worries me. We've had our first sizable decrease in the risk dial from 89 to 75. As you see, it's been stuck on 89 for quite some time, and on Friday closed at 75. It's the first movement, and I normally go for three movements down before I get too worried. But we are at very high levels, and therefore it's warranted to have a little bit of caution at these levels. The moving average differential also went down on the dailies and also on the weeklies for the first time, in quite some time. It's showing at this stage indecision, but as we shall see in the spreads, there is the distinct possibility that it could back up some more. Equities are fairly fully priced. You will have seen that my ultimate target here is 22 times forward earnings of the can have a look at this chart. Basically 22 times forward earnings of about 170, giving us 37.40. I think it's going to be very, very difficult to break through 37.40, and you saw when we got into the 3700s there was very little oxygen up there, and we fell back over the course of last week. I think that trend is going to continue, simply because there is very little leadership from the stocks which took us so much higher, i.e. the FANG stocks. We shall examine that. We are basically bumping our heads against the 37 to 37.40 level, so at some stage, with some bad news, we could get a little bit of a pullback. Having said that, there is absolutely nothing negative in deviations or in the equity charts per se, as we shall see later. This trend seems to be fairly well anchored. We are going up very, very slowly. This is the SPY. If we look at the individual sectors, XLE, it has broadly changed its trend, but it's very close to the reds. IYZ, equally so. The one I quite like is XLU. I think we are more likely than not to have a little bit of a rally in XLU, and that is why I'm slightly more positive bonds over the it's another confirmation that I should be slightly more positive bonds for the next couple of weeks. There's absolutely nothing that I can see in the deviations charts for the individual sectors that says that I should be negative equities overall, and I'm not negative equities overall. Better way to put it would be I'm slightly more bullish of certain sectors of the curve, which could cause equities to have a little bit of a brief dump, but that is going to be a buy at levels, and we shall discuss those levels later. The one I'm beginning to like least is XLF. I think the level that we picked as the top seems to have been very much the top, and I think XLF could come back, and we shall see how that fits into the relationship between IWM, i.e. Russell, and the S&P. Russell seems to be very, very fully priced up here, but we shall see all that later. And all this leads me to believe that bonds will probably be decent performance over the next couple of weeks, which makes me slightly more cautious about just buying equities at any level and letting the tide get me out of trouble should any develop. What is happening in bond land? Well, the very short answer is that the very short ends are as bid as hell. This is a chart of the 2-year yield. You can see it's very close to the lowest levels it has ever been. A lot of people have said this is going to zero, this is going negative. I don't think it's going to go negative. I think the Fed has every tool it needs to stop it going negative, and I'm sure that they will use them. So, there's do you really want to go long at 11 basis points? Well, you could see very close to zero for sure. Don't forget, this is December, and the banks need to do a hell of a lot of window dressing. So nothing should really surprise you in December as far as the very short rates are concerned. But having said that, there is absolutely no doubt that the overarching trend is one of steepening. This is the 2s, 10s, and as you can see, they just can't get below 75. If we look at Germany, the interesting thing is this is the bubble, and it keeps on bouncing, bumping its head against this 68, 69 negative basis points yield, and coming back to minus 82, minus 83. To me, this is a trend in all the short ends. The shorter ends are much better defined and much better bid. I have actually put this as one of the most interesting things to watch next week. Do we break below this level? I think if we do, the futures are going to go absolutely nuts. And, we are going to have a very quick, almost 15 basis points down to minus 96. It's going to be a big move, and that makes me slightly more concerned for equities, because if money flows into bonds, it tends to come out of equities, especially when they're very fully priced. So that's what's making me slightly concerned over the course of the next couple of weeks, plus the fact that everyone's so long looking for the Santa rally. I think you're more likely to get it here in the bubble than you are in the equities. I think the danger of a melt up in equities is very low. So this is now the Bund. I think the Bund really is not going to get much better than 72, so you're looking for not even 10 basis points there. So that gives you the overarching trend, which is one of basically the curves are steepening or stable. The big trend is one of steepening. So why go to the longer end if you can stay at the shorter end and have more bang for your buck? Now, this is the differential between 10s and bunds. This is very, very dangerous stuff. It could start going very easily back up towards the 190s, where it came from back when the COVID crisis broke. To me, this is a dangerous type of formation. I would prefer to stay in the shorter end of Germany. I don't know what that is signaling, but it's just telling me that the Santa rally is more likely to come in the short end of Germany, and that is worrying for the equities outlook, simply because people are so long and everyone's mindlessly positioned in equities, and a sharp reversal is indeed possible. As far as the US yield curve, not much to write home about. All the trends, as you can see, are definitely steepening trends. 530 is my favorite. You can see why I think this area here is so important that we shouldn't go through, certainly not beyond 154. I really do think that the Fed is going to be able to contain things here, and that we're going to spend quite some time in this, 154 to 109, 105 area, and build some kind of a, I don't know, right shoulder. But this period here is 2 years, okay? So I think that the curve is reaching the limits of how steep it can go without causing an accident, and I think the Fed is very much aware of that, and I think it'll manage it. So really, if now I'm becoming a better buyer of the longer end, while before I was a better seller of the longer end. But I still think that at some stage we will see bonds reach, certainly TLT reach around the 150 area, and that is going to be the time that you really want to buy it. This chart to me is very clear. Over the course of several weeks, we will get down to 148.90, that area, and that'll be a wonderful area to buy calls for a return towards 162. This is stability itself at this lower level. We've tried several times now to break it. We will break it eventually, but I think a squeeze over the next couple of weeks is far more likely. Have a look at how low we are here in the in the MACDs. A squeeze is more likely, and therefore I'm probably leaning towards a bond rally rather than an equity rally. But I want to be quite clear. I think it's going to be a corrective kind of action rather than the start of any big trend in risk off or anything like that. If you have a look at this is SPY over TLT, you see it's reached levels that it tends to back up from. And last week we had a little bit of a backup. Would it be unhealthy to go back down here? No, it would be healthy. A few weeks of stabilization down here, and then we can go again in the new year. That's the kind of thing that tends to happen. If we have a look now at a daily chart of ITOT over government, you will see that if we were to retest towards this line, where we broke out from, would that be unhealthy if we went back down to 3 from 307, which is like what, couple of percentage points? No, it would not be. It would not be unhealthy in the slightest, and I think it's more likely to happen than not. It will turn these moving averages. We're so far away from the 200-day moving average. We need a little bit of time to pass. That's all I'm saying. It's nothing that is going to change the overall trend or should worry any long-term investor. It's just a short-term trading. Absolutely no change in the dollar or in my view of the dollar. I think the dollar is in a multi-year bear phase, and I definitely think that we'll see this 88.44 and quite possibly this 84.50 level over the course of the next several months. It is very oversold in the short term. I mean, it closed, you can see where it closed within ticks of where it opened last week. Can we have a brief pullback towards the 92.60, 92.80 level over the course of the next month? Yes, we can, but I think it's going to get sold into. If we have a look at against the euro, which is the largest component of the DXY, we can see here that it's outside of the weekly Bollinger Bands, and so several weeks of consolidation here before we go up. Entirely possible. But I don't think that that's worth playing for. I think buying the dip in Euro USD And if we go back to DXY, selling the spike towards 92.60 are much better bets than anything else. To me, it's quite obvious that with such a heavy funding calendar in the States compared to anywhere else in the world, the only way you're going to get it is either you give people a higher yield or you give them a lower denominator, i.e. US dollar. I think the last thing the US needs is higher yields, and therefore much easier to give people a better opportunity to buy, to clear the funding calendar by buying treasuries than giving them a lower dollar and making them feel like it's a bargain. Very little change in gold either. We closed the week more or less exactly where we opened it, indecision, doji. But let's, logic has to rule here. And if bonds are contained, stroke rallying, if the yield curve is contained and we could get a bit of a rally in bonds and the US dollar is going nowhere fast, certainly not on the upside, any dip down towards 1765 is a buy. I really think that 1765 is such an important level. And although this looks like it's slowly rolling over, I don't think it is. I think any dip down towards the 1765 level is certainly an opportunity to buy some longer term calls. You can see from the stochastics that basically just trading is going, but within a bit of a downtrend, which I think is going to resolve upwards. It's a kind of bull flag, ABC, retracement, whatever you like to call it. Does it need more time? Yes, it probably needs more time. But I think after a period of consolidation here between 1890 and 1765, the break will be higher because the break in the dollar will be lower and the situation in the bonds is going to be contained. I am very much convinced that 1765 is a wonderful opportunity to buy for the longer term. Going on to equities, it's fairly evident, and it should be evident to everyone, that there is no leadership coming out the fangs at the moment. This is Apple. What can you say about this? Not a lot, right? It basically spent 3 months doing nothing at all. And I think it's going to be like this until the end of the year. Whatever chart of the fangs I look at, and Amazon, exactly the same. This kind of pattern is probably even slightly worse than Apple. But I'm not saying they're going down, I'm just saying they're not going up and they're not providing the leadership they used to provide. Facebook on a weekly basis, absolutely nothing. It keeps on bouncing off this kind of 250 area, and the best that can be said is they're not going down, but they're certainly not piling upwards. And that basically gives us a situation that we'll see next, where there is no leadership from tech. So this absence of leadership from the fangs is causing a sideways movement in all the spreads against technology. XLI over XLK, XLV over XLK. I really thought that this would go quite a bit stronger. XLF over XLK, basically everything is going sideways, nothing is moving. Qs over SPY, it's still it's correcting through time rather than through price. The moving averages are all catching up to it, so at some stage it's going to have another bump higher, but it's not going to be, certainly I don't think, next week. The one that is very interesting and is going to go one way or the other big time is Qs over IWM. And my guess is now that it's going to be upwards. And I tell you why I think it's going to be upwards is because something is brewing in IWM which I don't like. I think everybody is now long IWM, and I think the boat is just going to go, the other way. Always the way it happens. Not something that I'm betting on, but something that I'm very much aware on, and I'm getting out of the IWM longs in my investment portfolio. I think it's far too dangerous here. And I'll show you one chart that I think might persuade you. And this is that chart, SPY over IWM. It goes all the way back to 2000. Just like here, if you remember, the people who've been a charity hedge fund will remember we did the butterfly, long Russell, short S&Ps, long Nasdaq. That made us some fantastic money. And same in reverse here. In this kind of area, between 1.93 and 182, you want to put on the reverse butterfly, which is short Russell, long S&Ps, long Nasdaq. I think, or you could just do the spread S&Ps against long S&Ps against IWM. I think, are we absolutely, at the bottom? Probably not. But I mean, for longer term people, does it really matter? You keep on doing some all the way into here, and at some stage it'll break back above, and I would have thought you test at least this level, which is 212. So that's a 10% move that will take place over the next, whatever it happens to be, 6 months, who cares? But in a longer term portfolio, you don't really care. We predicted this move, we predicted the move back. I think it's quite easy to predict that we will see 210, 212, whatever it happens to be, over the course of next several months. This makes me very, very cautious about being long Russell here. And if I'm beginning to dislike Russell, I have to begin to dislike financials. And if I'm disliking XLF, I have to start thinking that the curve stops steepening, and basically the bonds can rally at some stage. So we're beginning to get, if not for next week, we're beginning to get a theme which is stability in the bond market to slightly better. And also rotation at some stage out of Russell back into both Nasdaq and the S&Ps. Much prefer to be long of bigger companies here that this retracement has taken place. I will not stop repeating that we're still outside the monthly Bollinger Bands, and that is never good. But having said that, the market is doing very little wrong. This is the weekly S&Ps. As you can see, we just cannot sustain the top of the Bollinger Band, which 37.05. Okay, next week it might be 10, 15 ticks higher. As soon as we get into the 3700s, we are in trouble. The real weekly support is 35.88. Okay, that is a wonderful weekly support. But from the shorter term time frame on the 195, you saw how we bounced off that 36.28.5 level like crazy on Friday. 36.28, which is on my sheet, is a very important level. Does this look like it's in immediate danger of anything happening? Absolutely not. It's that is why I'm saying it's more of a correction. But if we start breaking 36.28, you can see how the gap basically takes us all the way to 35.50. These are not big moves, these are not big corrections, and that is all I'm saying. Down here I'm a big time buyer, okay, anywhere between 88 and so 35.88 and 35.50, big time buyer. But really nothing to write home in the Nasdaq either. This is the 195-minute chart. It's corrected its weekly and monthly imbalances very nicely. It's basically saying it's quite stuck, but you can see how 12,600, 12,700 is going to be very, very tough to break. When it breaks higher by 0.25%, 0.5%, comes back. This is not an impulsive market. It's much more of a trading market, correcting in time, allowing all the longer term moving averages to come into it. 11,850 is a very, very important level, and 11,560 would be my guess if we broke down in the S&Ps that I showed you earlier. Those are very good buying levels. So no way am I saying that these markets are about to fall apart. I'm saying they might have a little bit of a correction, which is healthy, which is good. I just prefer bonds for a trade now, and certainly the short end of Germany for a trade rather than equities, but it's a marginal thing. EM, relative winner last week, almost unchanged. Probably the best performing. I would love to see it dumped down to 47.93 to buy the hell out of it. Will we get it? I don't know. Certainly the EEM spreads are continuing to look good. It is just improving. Here we have it against the SPY, EM over SPY. Am I getting excited? No, I want this line to be decidedly broken. It's going to take a long, long time, but we are now back to where we were at the beginning of the year. So I think it's quite, it's quite important that in a year we saw such tumult in everything, we are basically back to where we were at the beginning of the year. That is if we did a candle of this spread, that would be an amazing hammer at the bottom. So that is why I think over the course of the next 2-3 years is going to definitely pay to have quite a bit of money in EM. As you can see, this one is against Japan, and Japan has performed so well. Look, we are now higher than we were at the beginning of the year against Japan, and not to mention against Germany. I mean, it's just boom, a lot higher. So this spread against Germany, it's definitely turned. Against Japan, again, it's beginning to really turn and break through this previous line. You can see how flat the 200 period, this is weekly, okay, so this is, you can see how flat the weekly 200 period moving average is, and you can see how close we are against the States. So EM, I just cannot see any reason why you wouldn't be bullish of it. Nikkei, it's finally taking the pause that refreshes, but I see no reason why 26,000 or so. I've got the level in the notes. That's going to be the pause that refreshes for upwards, and again 30,000. Onto the sheet. I've changed very little. I don't see any change in any of these. I've just added that if it breaks 36.28, 36.28, It's going to be, it can accelerate quickly to 35.88.50, but that is a great long-term buy, I believe. The one I'm gonna take off is XLF. I now think that it's basically done everything it's going to do and it's no longer interesting, but I'm adding the bobble. I think on a break, or even when the market opens, you want to buy some calls, because this is going to be a quick move from minus 82 down into the minus 90s. Will it happen for sure? No, but I mean, I think the liquidity situation and the fact that it's December could see that kind of a move for absolutely no reason whatsoever, and technically it's beginning to look quite good. So I think that that is where the Santa rally could quite easily manifest itself. The S&P is, I think, 37.20. I mean, if we see 37.40, great, but it's not going through there, not in a hurry. I think the likelihood of a melt up is not very high at the moment. I think people are positioned far too long and they're far too complacent for that to happen. You have a look at that butterfly. I'm going to include that in the next few weeks. So basically, long SPX, short of the Russell, and long of something like the Qs. That is going to be a very interesting butterfly to hold in that range that I showed you, and I'll start filling in that next week for the subscribers with precise levels. Thank you very much indeed, and tweet you on Monday.